So thank you very much for everybody who is interested in this topic, in this paper. And this is really a working paper. So we started the project actually when Alina came to me and willing to do a PhD project. So we thought about the issue surrounding Chinese infrastructure investment in the global market. So the paper is co-authored with Robert as well. So I was supervised by Robert when I was in Groningen. And so it's very good to work together. And I said that Robert is very much engaged. So I'm so happy that we three of us are working very closely. So let me start with, so this is about Chinese infrastructure. So rather than going through the traditional way of, outline of the presentation, let me start with some background so that people can get a kind of idea about what we are talking about and what the skill is in terms of the Chinese infrastructure investment. This is the data that we have been using, actually taking from China Global Investment Tracker. They actually classified Chinese investment, overseas investment, into two categories. So this category, which they call as investment, actually this category refers to all types of investment, Chinese overseas investment, rather than infrastructure. So it can be financial assets investment, it can be government treasury bonds, it can be joint ventures in terms of shares, etc., etc. So if you look at the top 10 recipient countries for this type of Chinese investment, we actually see a pattern. That is, they are basically mature market economies. They are developed economies. They are, they are advanced economies. So in total, actually, that is the size of the investment between 2005 and 2019. So nobody knows the exactly size of Chinese investment, but according to them, this is the size for this type of investment. Now, the purpose that I start with this is to compare that one with this one. So this one actually is in the category of Chinese construction projects. So the majority of this group of investment actually is infrastructure investment, Chinese overseas infrastructure investment. If you look at the pattern here, we can see the pattern is very different from the pattern that we observed from the last transparency. So those are the top 10 recipient countries that have received the Chinese infrastructure investment in the same period. And that is the message that I would like to send out. Those are the less developed countries or maybe emerging economies. And those are the economies that they need a lot of infrastructure, but they do not have money to do so. So this type of investment is exactly what we actually care about in this paper. So this is the so-called construction or engineering projects. And this to give you a kind of idea about this Belt and Road Initiative, I took this from a recent issue of the Economist magazine, and I think it's a very good summary about what China has been doing actually in terms of infrastructure investment. So we see there is a road here, which we call, this is the so-called road, and then we have a maritime road or belt. Sorry, this is the belt and this is the road. Now, so basically what they do, because this is mainly inland Road. So what they do here is that they make connections between different countries along the belt, and that connection is very often made by new infrastructures. So new infrastructure investment along the belt by building up new infrastructure facilities, they make the connections, they reduce the for example, transportation times, shipping times, and then they expand international trade. So what China is doing here is to basically invest in the so-called dry ports. So a lot of dry ports, and dry ports are not really ports, but they are, you know, the node that the center that you change the hand of goods, for example. So they invested in that type of dry ports on the borders very often, and they developed the area, and they call them the free economic industry area or free trade area. So this is like the pattern. Along the sea road, they have another pattern. So here, actually, they are trying to be involved in seaports. So they have taken over quite a few. So for example, in Sri Lanka, this port was actually rented to the Chinese firms, I think maybe one firm, but that is the state-owned firm for 99 years. So this is another one. This is the port, and this is a Guada port, is another port that was rented to the Chinese firm. And then Djibouti, we all know that this is a very important location. China has been involved very heavily here. China has taken over maybe 2/3 of the coastline, okay, by running ports. And you heard the story of Greek port Piraeus. It was already under the control of the Chinese firm. So therefore, they have different strategies. So by doing so, they expanded themselves, and they are here at the so-called choke point, so that they can safeguard their trade. Okay, if we are talking about the economics here. So this is what China has been doing, and I think it is still doing, but after COVID-19, we do observe some, you know, suspensions, cancellations, renegotiations, etc., etc. But this is what we are talking about in this paper. So we are talking about the infrastructure investment undertaken by the Chinese government, because most of them are actually undertaken by the Chinese state-owned enterprises. So just to give you a brief idea about where China has invested in terms of infrastructure, in terms of the sectors, for example, and the area. So they basically invested maybe more than half of their infrastructure projects during the BRI period in the energy sector, in the transportation sector. And in terms of the distribution, regional distribution, Asia has received a lot. And I think this is, Africa and Middle East is coming up. So this is basically the current state. I mean, this is basically before the trade war and then before the COVID. So we need to wait and see what will happen after COVID. So therefore, the motivation for our study is basically to focus on this, the Chinese expansion into the global infrastructure market. So before the infrastructure, expansion, China had quite a lot, actually, the so-called OFDI. But that OFDI is different from what we are talking about here, because we are talking about the state-led expansion. So the government financed projects. And we also know that there are a lot of controversial issues surrounding this overseas infrastructure investment. They are mainly the debt problem. So a lot of media, the report from the media, we heard a lot of individual cases. And the transparency issues, because nobody knows why the project is awarded to a Chinese state-owned enterprises rather than another firm. And environmental issues, of course. So if they develop a mining, they have to destroy a forest, they have to pollute the water system and reallocate people, etc., etc. So those things are very controversial, and of course, social responsibility issues. So, however, in the literature, we do see that, think about it, those kind of infrastructure investment should be the responsibility of host country government. Yeah. However, we do see that a lot of host country government, they are not able to afford this type of investment. Therefore, they invite foreigners to participate in their own infrastructure investment. So therefore, you have the advantage, i.e., they help you to reduce your, deficit, government deficit. But in the meantime, it created a lot of issues in terms of the debt, and from there it causes some other issues. For example, they have to borrow more, and inflation will be higher, etc. So therefore, that will hurt maybe consumption and income, etc., etc. However, what we are talking about here in terms of the Chinese investment in the infrastructure, we very often observe that actually the model is different. The operation, the whole operation is different from what we have observed, based on the literature. So therefore, as I said, that Chinese overseas investment is different in the sense that everything is state-led. Finance is provided by the state-owned policy banks, and the project also, the financing is also related to other commercial banks, but they are all state-owned. So the model is different, and China, you observe different patterns in terms of this type of investment in different areas. So for example, in Africa, I think we all know that it is resource-seeking motivated, with maybe some market-seeking motivation, but resource-seeking is very important. It is mainly infrastructure-led, and the payment, in terms of the loans, the payment, they have their own special model, and that is the Angola model, i.e., I do the infrastructure in return. If you are not able to pay, that's fine. You just sign another deal. That allows me to get your natural resources or some kind of commodities for the next maybe 20 or 10 years. So this is a kind of a financing way or payment. In the EU, actually, that was really after 2008 financial crisis. So it is more technology seeking. So Chinese firms went to the European countries. They look for strategic assets. So the finance model is also different. And here we see the PPP model, so which is a common practice that we observed in mature market community. Okay, and that's fine. So this one, and then we have the BRI model. So it is mainly market seeking, and in addition, the financing is also different. And here we have the so-called boat model. So Chinese firms go to the host country, they build the project, they operate at least for some years, and then when the time is coming to repay infrastructure loans, if the host government is not able to repay, then fine, you just need to rent the project to me for maybe 30 or 40 years. So this is the model that they are doing, that we have seen quite a lot along the Belt and Road countries. Okay. So therefore, we think we can do the following things in terms of the contribution. We can maybe add, not maybe, so we will add something in terms of the economic impacts of Chinese infrastructure investment on host countries, because the studies are coming, but still not really very soon in terms of the economic impacts, of this type of investment in relation to host countries. So we provide economic impacts. Previously there were case-by-case studies, but this is economic analysis. And we try to compare our results. We try to examine the different across the 3 regions, Africa, EU, and BRI. And also, I think we have applied quite innovative way of using supply side instruments. So so that's basically the start of everything. I will use another maybe 10 minutes to go through the literature review. So as I said, that in terms of the underlying theory, we have nothing new. This is just the growth model. This is just the economic theory. So this is mainly economic paper. So so there are some studies in terms of whether or not, or to what extent, a country should invest in infrastructure. Basically, there is a debate about that. Some people argue that infrastructure investment is very good because it creates jobs, additional jobs. It motivates, activities from the private sector. However, the counter argument is that you should not have that much infrastructure investment because it occupies public money. So therefore, if you borrow too much, invest too much, then the government has to borrow continuously from the public, and that is not good for the private sector. So basically, we see those things, but this is not new. So people probably people have already heard those things, and they are very standard. So in terms of foreign investment in host country infrastructure, there are not so many studies on this in terms of the theory. Again, it is growth theory, so you just need to consider what the benefits are if you invite a foreigner to your country and to do the infrastructure project on behalf of the host country government. So as I said, that it is good in the sense that it accumulates host country capital stock. So in the longer term, it is good. Then it can stimulate private sector activities. It can increase government revenue. If you think about, the benefit that will be created by new infrastructure facilities. So, however, they also say, yes, it depends on the bargaining power of the host country government. So it depends on how you distribute the revenue that you collect from the infrastructure project between foreigners and the host country. So if I apply this to the Chinese context, so probably I would say, yes, it helps them to accumulate capital stock. I'm not sure whether Chinese investment can promote the host country private sector activity, and maybe it helps the government, local government, to reduce their deficit. But I'm not sure the final result if we consider the way that they pay back, okay, the debt issue. So therefore, there are a lot of things. If we apply this to China, they appear differently. So therefore, that's something that we should keep in mind when we are doing empirical research. So so in terms of, so I said that only recently, we saw some, papers that were published in development-oriented journals, for example. So a group of papers are actually based on this data, the aid data. I think this is a very standard, a very good data set, and they manually collected them. And the data was, the data is between 2000 and 2014. And what they look at in those papers are mainly aid projects. So official development assistance projects mainly. So in this data set, the data set actually contains half of the projects that are aid orientated, and the other half of the project that are really infrastructure, orientated. So therefore, they use those data across different countries, so analyze whether or not the Chinese state-financed projects are actually beneficial to host the countries. So the general result is actually, yes, they are. So for example, this paper, they looked at inequality. So they use the nighttime light intensity. So the dispersion in nighttime light intensity as the indicator to measure inequality, let's say that way. So they actually concluded that the Chinese state-financed projects, they reduced inequality or disparity in terms of economic performance. Okay, and so this one, the second piece of research is actually about 8 projects. So they found, and they compared the 8 projects with what is that commercial orientated projects. So so actually they said that yes, 8 projects are good, but commercial or less conventional projects, Chinese state-financed projects, they do not really promote economic performance in recipient countries. And further, I mean, the same group of people, so they investigated, so what are the determinants in terms of different category of investment. So basically between aid projects and non-aid projects, they concluded that actually for non-aid projects, they are driven basically by economic factors. So trade ties, natural resources, and etc., etc. So therefore, more commercial orientated Chinese state-financed projects are more, I would say, economic orientated. So they need to have a kind of rate of return. Okay, so that's one group of study, and another group of study, I think those are the new things. So those are on the BRI. So the data is relatively shorter. So they started from 2013, but still they did some research. For example, the World Bank report actually was the first piece of BRI projects. So they actually did some econometric analysis, and they found that Chinese BRI transportation projects are actually very good. So they reduce the trade cost, reduce the cost of doing international trade, and then they promote economic performance. And more recently, I think this is from Journal of Development Economics, and they actually, again, they used the BRI projects, the BRI transport projects actually, and they actually developed a good model which they consider actually both the benefits and the cost. So therefore, they have the welfare. Welfare means you need to consider the negative consequence by taking a lot of loans. So they found that in general, yes, Chinese BRI transportation projects actually they are good. They are good enough to increase BRI countries' GDP per capita. I think GDP per capita. So by that much, also welfare, and also because of the connections, they say it's also very good for actually neighboring countries, even though they are not really under the BRI umbrella. So that's some evidence that we in terms of BRI. And for the debt problem, I probably would like to skip a little bit because I think time is passing so quickly. So and there is another group of study in which people actually exclusively focus on the debt sustainability problem. So those two studies are this is a working paper and this is a published one. To summarize, there are some debt issues. So there are some countries that are involved in Chinese infrastructure investment because of their infrastructure borrowing from China, they will suffer from severe debt problem. So we are not going to actually explicitly empirically test the debt issue in this paper. We focused on the GDP, the growth model, but we control the debt as a variable. So in terms of another group of researchers, so I would say those things are mainly the evidence that I can justify the motivation of Chinese investment in a particular region. So for example, those two studies actually, yes, so this one added some evidence saying that, okay, if the Chinese state financed projects are commercial, are not really aid-oriented projects, then they found that actually those projects, and basically those are the infrastructure projects. So they are driven by market size, natural resources, and trade. So we have already had something earlier, and we saw a piece of research particularly examined the way of debt payment in Africa. So therefore, they reported that actually more than half of the infrastructure loans in Africa during this period, 2003 and 2011, actually were paid back by commodities. So it's a barter, really, agreement. So I checked the recent practice. Actually, yes, they are still, this type of payment is still very much in use. And for Europe, we had some paper to justify that the motivation is mainly market seeking, technology seeking. And for BRI, we are not sure about the evidence yet, but the trend is that they are very good for international trade. So what we are doing here actually are different from the previous literatures in the sense that we use a very up-to-date data set. We touch upon the differences across different regions, and we try to use a kind of a fresh, a new treatment for this endogeneity problem. I mean, so that's very. So this is the model that we are going to use. So this is my last page, and I will hand it over to Alina. So so we have two stages. So in the first stage, we use I-way, and that I-way is taken from China, and then we multiply this I-way by a host country characteristic, i.e. the probability of receiving Chinese investment. So we use this to do the first stage analysis after controlling some other variables, and we get a fitted value, and then we put that fitted value into the growth model. Okay, so this one is difficult because we have tried different things, and at the moment we got this one, total social financing from the Chinese financial system, as the supply side variable, and then the probability that we used is the ratio of how much investment the host country I received in year T divided by total Chinese overseas infrastructure investment in that year. I mean, among the sample countries. So otherwise we do not know. So we had this one. So Robert knows more about this, but you know, I will go over. So the justification of using this approach is based on the aid literature. So think about the aid literature. People are trying to use this aid variable to explain host country growth. Okay. However, the endogeneity problem is probably the most serious in this equation, because one developed economies, when you are providing aid to a host country, you often provide aid money to the countries that are economically very, very poor. Okay, so therefore the endogeneity problem was I do not know whether it's solved or not. They say they solved this problem in the aid literature, and they use what they did in this paper. In this paper, actually, they used what is that? So the number of factions, so political factions in that country, and they multiply this one by the probability that the host country received aid. But they constructed the probability by the ratio of a number of years that the host country I received aid, the number of years divided by total sample years. So ours is a little bit different. Ours is a year by year. So, so the idea is if you have if you observe more fictions, political fictions in that country, very often the aid budget is higher, because no political fraction would like to cut their budget in terms of foreign aid. So that's basically the idea. So they say after they used this type of approach, basically they didn't find anything. So aid is not really positively related to growth. So I think this is something that I would like to stop here. And Alina is going to talk about how exactly we measure the variables and then the estimation result. Alina, are you ready?
Yes, thank you, Professor Bo. We talk about the measurement of variable. We have GDP, which is the natural logarithm of GDP per capita of the host country as our dependent variable. And this essentially measures the economic performance of the host country. Next in line, we have the Chinese Infrastructure Fdi, which is the ratio of total value of Chinese overseas infrastructure investment to the GDP of host country. And this is measured, as Professor Bo has mentioned, it's been downloaded from American Heritage Institute, American Enterprise Institute and Heritage Foundation. Next, we'll have three variables which we have put in our growth, in our regression as to measure or proxy for the motivation of Chinese investment. So we look at trade to China, which is the net exports to China of the host country. So it is essentially the exports to China less imports from China, and it's also scaled by the host country GDP, and it is a proxy for market-seeking motivation of Chinese infrastructure investment. Next, we have natural resources, which is the natural logarithm of total natural resources rent to the host country GDP. Rent is the total revenue that can be generated from the extraction of natural resources, and we take away the cost of extracting the resource. So that's what natural resource rent means, and it is a proxy for resource seeking motivation of Chinese infrastructure investment. Next in line is technology, and it is the natural logarithm of total number of trademark applications, and it measures the technology seeking motivation of Chinese infrastructure investment. The next list of variables is actually used in all growth regression models, and they're quite common. And these control variables include risk index, which is the average estimate of governance indicators. So countries are allocated ranks, which start from minus 2.5, the lowest rank, to 2.5, which is the highest rank. And these ranks are allocated on government effectiveness, control of corruption, political civility, regulatory quality, rule of law, and voice and accountability. And the highest rank means that so the higher the risk index means the lower the risk. So next we have human capital, which is the ratio of total secondary school enrollment to the population of age group that are eligible to attend secondary school. Then we have existing infrastructure, which is the broadband subscription per 100 people, government debt, which is natural log of gross government debt as a percentage of GDP, and private investment, the ratio of gross capital formation to GDP in the same period. So these are basically all variables which are generally used in growth regression models and are quite common. Can we have the next slide, please? Thank you. So in regards to the sources of data, we have the information on host country variable is taken from the World Bank website. The variable for technology is taken from World Intellectual Property Organization, and some of the variable, for example, the debt, is taken from the IMF website. If I talk a little bit more about our main independent variable, China's overseas infrastructure investment, Professor Bo has already mentioned that it is Chinese construction contracts, and construction contracts are essentially different from investments in the sense that in a construction contract, a Chinese company is building for another party in a foreign country, and its involvement ends after the construction is complete. And the main difference is basically that it is from the state-owned enterprises that make these contracts. And for our paper, we have identified 1,558 Chinese construction contracts from 2005 to 2019. And our sample covers 105 host countries, of which 46 are African, 23 are European, and 36 are along the Belt and Road Initiative. Thank you, Professor. Can I have the next slide, please? Thank you. So in this figure, we have China's infrastructure investment as a percentage of host country GDP. So from 2005 to 2019. this basically explains the Chinese involvement in host country, and we can see that Chinese involvement is highest in Africa, especially in 2016, where it is almost 1.2% of the GDP, which is quite high. And then we can also observe an increasing trend in China's infrastructure investment in Africa. And also, if we look at the Belt and Road Initiative, there's an increasing trend over there as well. But especially in Belt and Road Initiative, if we see after 2013, when this initiative was announced, the increase in investment, the increase in investment is quite a lot from 2013 to 2016. So China has started investing a lot after the announcement of the Belt and Road Initiative. And if we look at the European investment, we can see that as a percentage of Europe's GDP, it is consistent and it hasn't changed a lot over the years. Yeah. Next, we talk about the empirical results, and these tables show the impact of Chinese infrastructure investment on host countries for our whole sample combined. And we have the, for our IV regression, we have the first stage results and the second stage results. The first column shows the first stage results. And with the first stage results, we can test whether our instrument is relevant and whether it is weak or not. So if we look at our first variable, which is total social financing, we can see that it is the estimated coefficient is positive and significant with the Chinese infrastructure OFDI. So this suggests that our instrument is relevant. And if we look at the right-hand side table, and we can see the Clyburn Wild F statistic and Craig-Donald-Wild F statistic, and we can see that the values are greater than Stock-Yogo ID test critical values. So this suggests that we can reject the null hypothesis that our instruments are weak. So this instrument, this suggests that the instrument total social finance is relevant and is not weak. However, our next step would be to perform another test, which is the test of over-identification. We cannot do that without another instrument. So we're working to get another instrument to perform that test. Currently, we do not have that. But when we have that, we will be able to test for joint instrument validity, and we can test the null hypothesis that both the instruments are valid and uncorrelated with the error term. So for now, we just have this one instrument, and we can see that we can test that it is relevant and it is not weak. Next, we move on to the variable natural resources in the first stage and in the first column. And we can see that it is positive and significant with Chinese infrastructure FDI, which confirms the resource-seeking motive of Chinese infrastructure investment. In the second stage results, for the whole sample, we can see in the first variable, Chinese infrastructure FDI is the estimated coefficient is positive and significant with the GDP of the host country, which suggests that overall Chinese infrastructure FDI contributes positively to the host country's economic performance. And if we move on to the other control variables, they're all in line with theory. So risk and human capital human capital increases infrastructure. Human capital increases the GDP, and so they're all in line with the theory. So sorry, can we move to the next slide? I know we're time constrained, so I'll just try to hurry up. So in this, this is a first stage set results for the whole sample, and we've divided the sample into 3 regions. So we can see Africa, Europe, and Belt and Road initiatives separately. So the main things to highlight here is basically that our the variable total social finance is the estimated coefficient is positive and significant for all 3 columns. So that means our total social finance is explaining Chinese infrastructure investment. And next, we can see that the natural resource is positive and significant for Africa. Sorry, the first stage, yes, table 4, please. Yes, so natural resource variable, the third variable, and the first column, we can see the estimated coefficient is positive and significant for Africa. So this is consistent with the fact that Chinese infrastructure investment, natural resource seeking is very important for Chinese infrastructure investment in Africa. And if we look at the trade variable, trade to China, we can see that for the Belt and Road Initiative, it is the estimated coefficient is negative and significant. This means that China invests more if the host country is not an important trade partner of China. And this is in line with the market seeking motivation of Chinese investment. Can we move on to the next table, please? Thank you. So this is our second stage estimation across the region for Africa, Europe, and BRI. We will only highlight the differences in the results. So in the first row, we can see our main independent variables, Chinese infrastructure OFDI is positive and significant with the host country GDP for Africa and for Belt and Road Initiative. So this, we believe that this is because China's infrastructure investment support host country economy with infrastructure gap. For example, low developed countries in Africa and low developed countries in BRI. So if there is an infrastructure gap, only then Chinese infrastructure investment is proving to be beneficial for the country, for the host country. We can see that our the same variable, Chinese infrastructure investment, is insignificant for Europe. And according to literature, if the source country has a lower research and development intensity than the host country, then a negative spillover may exist. And these spillover effects can be generated from a possible market stealing effect of the relative technology laggard. So this is mainly because this effect can be caused by more productive multinational corporation, Chinese multinational corporation, taking the market share from less efficient domestic producers and forcing average cost curve up and lowering their productivity. Next, we look at the variable trade, which is negative and significant for Africa. And this can be explained by the trade between China and African countries is often related to commodity-based infrastructure debt repayment. So Professor Bo explained that in detail. And then we have the trade variable, trade to China with BRI is positive, has a positive relationship. And this is because of the connectivity that BRI projects, transport project provide, and this can reduce the cost for host country and improve economic performance. Then lastly, we look at the variable debt, which is negative and significant for both Africa and Belt and Road Initiative country, and this indicates that the debt burden is severer in less developed host countries. So next we move on to the to the summary of our results. So basically, we summarize that China's infrastructure investment is mainly driven by resources seeking in Africa and market seeking in Belt and Road Initiative country. And China's infrastructure investment improves the economic performance of host countries in general for the whole sample, and especially that of Africa and for Belt and Road Initiative host countries. Host government debt hinders economic performance in Africa and Belt and Road Initiative countries. And with regards to the European Union, there is no clear-cut evidence whether what is the motivation of China's infrastructure investment in that region and the impact of the investment in that region. Now, I would like to invite Professor to
yeah, thank you, Alina. So I actually asked Alina whether you are willing to do this. Alina said it's better you do. So I will finish this presentation by just briefly mentioning some policy implications. So I think if you think about the debates or the controversial, the issues surrounding Chinese infrastructure investment in the global market, we saw very often the case study or case by case. So I think international policymakers, whether you are the government from a developed economy and you are thinking about whether or not you can make a deal in terms of the infrastructure with the Chinese government, and also maybe you are working for an international organization. So in terms of aid financing, I think we can provide some evidence, and this is the systematic econometric evidence. So that can be much more informative to me. And also we actually identified some regional specific factors. So we did see something that perform actually differently across different regions, and that is very good for regional regulators, regional government to think about how to negotiate with the Chinese government in terms of the future deals, etc., etc. And we also, I said that is not a big issue for this study. However, if you look at some of our sample countries, like Djibouti owes to China maybe 2 years ago 104%. So and now it's 88 something percent. So if Chinese government ask them to pay back Chinese infrastructure loans, Djibouti has to hand in the whole economy. And of course, you can argue this is nominal, it never happened, etc., etc. So we have a lot of, countries in our sample, their debt ratio to China actually is very high. So this can provide some indication about, how and when you can say no because of your debt problem. I think we need to do more empirical studies in terms of the countries in EU, because if you compare, for example, Hungary, Greece, and countries like this with the UK, with Belgium, for example, they are different. So we need to identify the special things in terms of, even they are EU countries, but they have different types of relationship with China. So China is doing things differently. So those are the things that we can take away and think about it. And then for us, we will consider them maybe in the next step. So I think we will stop here in terms of our presentation. And I'm sorry we used a little bit more time, but I'm very happy to hear what you think about it, and we are collecting comments. So thank you very much for your patience.
Oh, thank you so much, Hong and Alami, for such a clear presentation on a very interesting topic. So I think what I do now is to open the discussion to the floor. If you want to ask a question, please use the hand or raise your hand bar, which is indicated on the top panel. But meanwhile, colleagues prepare their questions. There are a couple of comments that have been posted in the chat. So let me go through those first, and then we'll come to see whether, okay, these have been, okay. The first is again, to both Alina and Hong, and maybe Robert, if he wants, he can join in this answering these questions or responding to them. The first is from Richard Alexander. He says, do you think that the China-US trade war will cause China to intensify its investments further in developing countries to try to gain further influence at the expense of the US? Okay, any comments to that?
Yeah, so I respond, or yeah, I first respond, and then if Alina has something to add. So I think yes, if you think about Cambodia is a very good example and very current case. So I think last week America has agreed to provide Cambodia quite a lot of money to support their infrastructure investment. But on the other hand, if you think about Chinese involvement in Cambodia, it's already massive. I followed the pattern, and the pattern is very similar to Djibouti. So they are building another airport, and they are discussing about a possible military base. So that was the reason that America is trying to stop China from further, investment. So I think yes, definitely. I mean, China after COVID-19, China is facing much harder, situation. So more restricted screening system regulations in the EU. So I think it's good opportunity for the Chinese government to think about it, to think about how to develop further. But in addition to that, I would say, yeah, there are some other regions, Middle East and North Africa. So I think it's coming. There are and Central Asia. So yes, you are right, Richard.
Okay, thanks. The next comment, I possibly ask him to ask this to make this comment. Mehid Bayadi, on your debt trap question. Do you want to ask directly, Mehad?
Hi, sure. Thanks very much. Yeah, I was just wondering when it comes to the, I guess, increasing prominence of this notion of the debt trap as a way of trying to explain China's approach towards the African continent, whether you thought that was a useful lens, whether you thought there was any substance to this claim, or whether you think it's slightly too simplistic.
Yes, and I had added to your comment, Abed, which I liked, something about the looming debt crisis in Africa.
Yeah, exactly. Yeah, and just to follow up, okay. If you could give any comments on what's happening in Zambia,
yeah. Okay. So, Alina, Hong, or Robert, who wants to go?
Alina, would you like to try?
Okay. So basically, the claim of debt trap, I think, is well, essentially, China is investing a lot in these areas, and China is. I think it's there is a lot of substance to it, because it does make because it's not only China just investing for the sake of profit. Otherwise, private investors would also, Chinese private investing companies would also jump in. But with the data, we can see that mostly, especially the infrastructure projects, is mostly concerned with the state-owned enterprises, and there is a political motivation to invest there as well. So I think it is contributing to African debt trap, which I think is the claim is relevant.
Thank you, Alina.
If I can add a little bit more, if you look at the situation after COVID-19, African countries were affected very much so as compared to some other host countries. So in April and May, actually, we heard some African countries, they wanted to renegotiate with China for the infrastructure deals. So I think there is another issue, to be honest, the host country issue. So host country government, they should know when to say no. So you need to really protect your own country by saying no. However, I know money tells, so sometimes it is difficult to say no, but that's the debt issues is very much related. This is remember, bilateral, all bilateral deals. We need a multilateral, so we need somebody who can monitor, the participants. So I think that is the debate.
Yeah, thank you very much, both Alina and Hong. I think it's the debt sustainability, argument. The external monitor, observes settings. For example, the World Bank and the African Development Bank in Africa, they observe strictly some of the settings. So even when countries may qualify to borrow, it's the changes in debt levels can actually prevail against that. However, corporate finance does go against that argument of debt sustainability, because in corporate finance, as long as you are borrowing able, there is the advantage of debt, and as long as you are able to invest and get returns higher than the cost of debt or the cost of capital, then you are in business. So I suppose at the end of the day, this is huge, and the empirical issues they are involved. Okay, and there is a comment by Francois Botiano from Laval in Canada. Francois, you talk about the Angola model. That's very interesting.
Yes. Hi, everyone. My point is you mentioned that most of China infrastructure investment are based on Angola model in Africa. And they invest in the infrastructure sector and also invest in the energy sector, which is used to pay back the investment in the infrastructure sector. My question, how do you entangle this fact and measure the productivity in this sector?
Yeah.
It's difficult. It's difficult question. So, but they signed the deal with the Chinese. The way is that they do this is the following. So you sign something with another Chinese state-owned enterprise, and you agree to supply, for example, oil or cocoa. In the case of Ghana, they supplied a lot of cocoa to China. The deal is made based on how much money you should pay, but you do not know that amount of money that you can pay because the price is not fixed yet. So the price is actually dependent on the market price when that export is going to take place to China. So it is the state-owned enterprise, another state-owned enterprises in China who is going to import those things. However, the money things is taking place between the host country, government organization, or that firm, and the Chinese policy bank. So the bank who provided this money. So it is difficult to measure the performance of this deal, and this is exactly the question that we have been asking actually along the way. So that I think we are paying attention to this and see how we can measure the economic outcome of this type of deals.
Thanks very much. Thanks, Francois, and also Hong for this response. Maybe Richard, you can come back here. I'm just going by the order of the comments in the chat. They are quite a number. I come to those who are still waiting. But Richard, here you mentioned something about the Heritage Foundation. I think about the data and the measurement of some of the variables. So, Richard.
Yeah. Yes. I just wanted to flag up. I mean, it's a basic rule when you consider the agenda of your sources, but the Heritage Foundation is well known to have a pro-US, a US politically conservative agenda. And so I was simply saying, be careful, be careful when you take data from them. I wasn't saying more than be careful, just be aware that the Heritage Foundation has a political agenda that is not exactly pro-Chinese.
Yeah,
So,
okay,
Alina,
thanks.
Alina, you can respond.
Yeah, I do agree that it is an American data, so there might be some maybe will to kind of inflate the infrastructure investments and maybe suggest that there's more, but they do compare with MOFCOM. So they have papers written on how on their investments and their analysis, and about MOFCOM and the investment MOFCOM has reported. So they do compare the data, and then they check if there are any irregularities, why is that, and they have actually posted online on their website quite detailed analysis of both. So it might be useful to read. So and a lot of papers have already used this data, and now the trust in data is developing even more. So I do agree that we need to be aware of the fact that it's American, but still there are things that they've explained.
No, that's fair enough. I wasn't so much concerned that it's an American source than that it's a politically conservative American source.
Okay.
Okay.
But that's fine.
Yeah.
Their data, right? The data, we see the numbers.
Yeah, exactly. I think there will be, it will be footnoted or indicated about the limitations of that, possible limitations of that database, and also the other available data that may be used to do robustness tests if there is high contention of the data. Okay, there is now a further question. Yes, further about the debt trap. Catherine, that's a very interesting question.
Good afternoon. Yes, my thesis actually looks at the countries that are struggling at the moment to pay back the debt. And looking at what's happened like in the last few months with the oil prices dipping. And as well, I'm told in Uganda, the oil purification process is quite extensive. So that will require a lot more costs going in than what's expected to come out. So what would happen in cases where you find that the expected commodities don't value up to the repayments, and as it is, the loans take a lot longer for the governments to pay them back? What can be anticipated in this case?
Yeah, that's interesting. Thank you, Catherine.
I think that is already happening in some of the countries. For example, if you see in Malaysia, there are a lot of contracts that are being renegotiated because they fear that they cannot keep up with the payments. In African countries as well, I think a lot of governments are becoming concerned regarding this. I think what happens is that China is the Chinese government is flexible in this regards, that they change their model or they renegotiate. So and a lot of this investment has been made by foreign, especially the Belt and Road Initiative one. It has been made by foreign exchange reserves that China already had. So so I think they can still Chinese government can still provide some alternatives to kind of keep the governments keep the host country government going.
Thank you, Alina. And there is a follow-up question by Christine, which is very interesting because it involves issues of debt valuation and debt amortization. Christine.
Yeah, thanks, Victor, and thank you, Alina and Hong, for the paper presentation. It's just last year we had a very interesting paper by Machiko, if you remember, looking at this question of the cost of interest payments from African countries to China. And I just wondered if you had, sorry, forgive me if this was in the model because the slides went up very quickly and that was a while back. But yeah, if you've taken account in your model of the outflows of interest, so you're looking at the inflows, whether you've taken account of the outflows of interest payments or where commodity payments are made in lieu of interest, whether you value those and include them in the model in any way. So you're kind of looking at the net effects of the investment.
Yeah. Yeah, definitely. And thanks for that, for pointing at this issue. I said, yes, we, first of all, we do not have data on commodity payments. We have to manually collect the data if we want to have this. And secondly, we do have a debt variable, which is called debt to China from host country. So that's what I discussed with Alina and Robert, that we are going to continue to do the regression by using debt to China rather than total public debt. Even debt to China is not necessarily related to the commodity payment. So we still need to identify project by project and the way that they pay off Chinese debt, and then we know what commodities are involved, and then we can go to the price, market price of the commodity, etc., etc. So we do not have that commodity, data. So, but maybe that's something for the future. So that's my response.
And if I could just add one comment, but it doesn't really need a reply, which is your instrument, which is multiplied by the probability. I mean, I wonder whether it is best to call that variable a probability. I mean, it is the probability in the sense of China investing, but it's not really the probability of a country receiving investment. It's more like the share of, it's simply the share, isn't it, in a way, of Chinese investment in a particular country. Maybe it's best just to think of it as a share rather than a probability.
It is a share, but apart from this share, it's just the term. So how do we call that? It is a share, but I think in the aid literature they use the similar concepts as the probability of receiving. Of course, it's not a pariah; it is ex post. So just to use secondary data to measure the statistical probability. So that's the logic, I think. But I agree, it is the share. It's not the probability.
Thank you very much. And let me see. I think any further comments, or you can raise your hand and please, if you want to comment or ask a question or add something, or whether Robert wants to add something, observations on this.
Victor, I saw Aisha. Aisha's hand is up.
Aisha?
Aisha's hand.
I can't see them. Okay. Aisha, yes, please. Yeah.
Thank you very much for the excellent presentation. It's quite a solid work and the results are quite promising. Actually, Christine has almost asked the similar questions that I wanted to ask. My question is similar, but from the perspective of is there a way forward for a comparative analysis where we could have a chance to observe China's performance relevance to its peers? So like market share of China among its peers, how does China's market share in these infrastructure investments affect your outcome? So instead of a comparative analysis for the host countries, what would be the results if we take into account the infrastructure investment shares of other countries? When we take into account the whole infrastructure investments made by other countries? So this is my question.
Alina, do you have anything to say?
So I didn't really understand the question very clearly. So
that's fine, Alina. I will. So, Aisha, thank you very much. So I do not have a specific statistics at this moment, but what I know is in Africa, Chinese infrastructure investment, I think they estimated that in 2018, the proportion of Chinese infrastructure investment in terms of the total infrastructure investment that they received from other foreign countries, China is the top one, was the top one, okay? So if you say the whole structure, that I do not know. But I know in Africa, Chinese proportion was the top in 2018. In addition, I know the most recent figure shows that China is now the top one creditor to developing countries. So China basically is the most important country that has provided financing for developing countries. So by using this, I can derive that maybe, you know, in terms of the whole market structure, China plays a very, very important role. But I can check. But that's a good point for us to really understand the whole thing. Thank you.
Simply, put it simply, the question is, how does market share of China in the infrastructure investment affect the economic performance of the host countries? So this may be a way forward for your existing work. Yeah, thank you so much.
Think about it. Let us think about it. So the market structure for the market share. But I tell you, China is very important in terms of the market structure.
Yes, thank you so much.
Thank you.
Thanks, Aisha, for that contribution. Yeah, because you can think actually broadly, not only of the market share, you can in terms also of investment share compared to other investors from OECD countries and others from from developing or emerging countries. It can also be the debt share. In fact, it is important to note, especially with respect to the debt issue that came up at the start of this discussion, that maybe around the 1990s, many countries in the world started to consolidate the debt office, the debt, especially in the ministries of finance. And I think I can see quite a number of, policymakers here in the audience who may have been involved in this. I can see Ron Bolanda from FZDO. I can see Rose Ngugi from Kipra, because by that time they were trying to monitor the debt, the debt for various countries. And I think monitoring of the investment and then be able to determine the share of China's investments in the country and also the debt, is so important, especially in the monitoring process. Also very important for us doing some, empirical work. I can see. I think that's another hand, Aisha. Right? That's another hand, right? Okay. So
yes.
Jun Hong Young has put in. I suppose this is a purely econometric question, right? Jun Hong.
My question is very simple. I just not very understand how does the instrument satisfy the exclusion condition.
Can I ask Robert? Robert, can you please answer this question?
Robert is still with us?
Still with you. Sorry, I missed.
Okay,
Robert,
good.
It's your turn.
Sorry, I missed it. So you have to ask the question again. Sorry.
Okay, it's in the chat box. I think my question is asking how does the instrument satisfy the exclusionary condition? So I'm not very clear about how you are construct this instrument and how we meet the purpose to try to address the endogeneity problem in your.
So in this case, we couldn't check for the exclusionary restriction because there's only one endogenous variable and one instrument basically. So that is not tested here. We did alternative estimates where there were two instruments where we could check. So that was giving almost similar results. But this instrument we used here was kind of theoretically better to, let's say, yeah.
So I'm not asking your testing. I'm just saying what the underlying story can satisfy this exclusionary condition.
The underlying story is that the let's say the total Chinese investments, with the total infrastructure investment that China makes is somehow is highly related to the financing structure in China. So the total financing in China, but the total financing in China, the domestic finances, has no direct relationship with the GDP per capita in the let's say in the countries abroad. So the only way that the instrument can affect GDP per capita of the recipient countries is via infrastructural investment. So that's the reason.
Okay.
So there's a high correlation between the instrument we use and outgoing Chinese investments total, and there is no direct relationship between financing in China and GDP per capita in the recipient countries.
All right.
Yeah.
And Victor, can I add two things? So I think Junhong wants to know the economics behind this. So to me, total social financing is relevant to Chinese overseas infrastructure investment in two ways. One is it is the total financing that was provided by the Chinese domestic financial system to the private sector. So therefore, that means that the economy is doing better. That means the private sector has received more liquidity. So there are more liquidity in the system. So, and in terms of the government revenue, and this is a good thing. In addition to that, the system, if you have a lot of liquidity, then the interest rate is lower. So that is helpful for the Chinese government to organize financings. For example, some banks, state-owned banks, are issuing bonds, particularly for some infrastructure investment. So this way, I can make the connection why total social financing is relevant. It's only relevant for Chinese overseas infrastructure investment project because they are financed by the government, but they are not related to the host country economic performance. So that's my
yeah. Which yes, as very consistent with what Robert was saying, and I was sort of here for way of instrumenting. Okay.
By the way, Robert does not like DIM. We had so many DIM results, and it is him who actually said, no, we can't use DIM.
Okay.
He does not trust DIM anymore.
Yeah, so maybe a little bit, and that was also explained during the presentation already. This way of using instruments is being used in foreign aid literature, but also in other foreign capital type of literature. The basic idea is that you try to find the supply side instrument, so some variable in the, let's say, investing country, in this case China, some variable which is highly correlated with the total possible foreign investments China could make. So that is the basic idea. And as it is a supply side instrument, so coming from the Chinese government, it is hard to, let's say, it's difficult to see why this variable should have a direct effect on GDP per capita on the recipient countries other than via the variable we are interested in. So that's the economic reason behind it.
Okay. Absolutely helpful. And good explanation.
In the aid literature, in the foreign aid literature, there was the same type of discussion, and in the beginning of this aid literature, they tried to find instruments coming from the recipient country. Yeah, but then with the long discussions that all instruments coming from the recipient country, those are almost immediately and almost by definition highly correlated with all the recipient country variables. So they cannot be a good instrument. So from that moment, they started to search for supply side instrument, and we are following this literature.
Excellent. Thanks very much for that, addition. And again, that's an area that has been, full of many controversies, both in theory and in the empirical applications. Further questions, observations, comments on this interesting issue of China investment?
There are 2 hands up in the chat.
Oh, I can't see. Okay, now I can see one hand up. Peter.
Thank you, Professor. Thank you for the presenters for a very rich and exciting topic. But let me bring to bear my own experience with regards to China investment in Africa, especially for infrastructure. We at the World Bank, we used to keep on harping infrastructure investment, infrastructure investment, infrastructure investment. Then we found ourselves competing with the Asia Infrastructure Bank. So why? Because the Chinese are way ahead. When we are discussing a loan, which takes 2 years, Chinese in 3, 4, 5 months, it's done. So which means that they've got a competitive advantage, and they will always have a competitive advantage. Now, we tend to relate that with the debt of the country. China will come and sit with the authorities. Of course, they will discuss the debt, but then they will find a way to be able to finance the project without paying much attention to the debts. They say if originally the project was to pay back in 20 years, okay, we'll extend it to 40 years. So, which means that they always have a competitive advantage. Tell me now, the questions which I asked to the researchers, which countries other than China invest in Africa? Tell me, I want to know. I don't think other than China, we have 1 or 2 flagship projects by EU, and that's it. So I think we have to be very careful and do a little bit more in-depth and fact searching to be able to find out what really motivates China to invest in Africa. Of course, they are the mineral resources, but it goes far beyond that. Thank you.
Thank you very much. As I mentioned, I introduced Dr. Peter Rose at the start of the seminar. Is a former finance minister for Seychelles and also executive director of the World Bank. And I think that question is important. Share the same experience with me at the African Development Bank in terms of the mode of operation for investments, especially in the African region. I don't know whether Hongbo or Alina or Robert, you want to add something to that?
No.
Alina, would you like to, or Robert is here. Yeah.
Robert? I can, not difficult for me to add here something. I think I agree. So I don't know precisely. So
yeah, I think it's a much appreciated comment to the interpretation, especially the final bit that Hong was explaining in terms of the policy implications and relevancy of the study. I think I just want to try to interpret the numbers, the results into something that relates to the policy dilemmas on the ground. Yeah.
So can I respond a little bit to the question? We are still on the same question, right?
It's a comment, actually.
So I think I accept that, we cannot really in one paper, we ignored other issues, political issues, strategic issues. We focused on economic aspect of this thing. I do agree that China has a different agenda in terms of Chinese expansion into the global infrastructure market. So, for example, you mentioned that African countries, they welcome Chinese money because they are quick. They are they come in with a large amount as compared to some other organizations, and they. But the problem is, I know that's what you probably meant, that China ignored other issues, corruption, humanity, so corruption, and they do not care about that. So that's a problem that causes social issues. So as I said, that I accept this, but we cannot really, in terms of data, in terms of so yes, I agree with Mr. Laros.
I would also like to add here that the same question that you asked, which other country is willing to make that investment? Even if you look at the World Bank or other organizations like IMF, they take so long to invest in these countries, and the African countries and the less developed countries, they need the investment now. And they have no chance otherwise if they don't have the basic infrastructure like electricity or things like that. They don't have any chance to compete in the world, and they get into that trap where they can't improve their circumstances. So that is why, as well, I think they welcome any investment from China. But then again, what Professor Bo mentioned, that is kind of too broad a scope for just one paper. So we might need to think about some other, another paper which we might focus on that.
Excellent. That's very good, Ranjana. So I think we are, unless there is any quick comment in the chat room or raise the hand, I can't see any. If you see any, please bring it to my attention. No? Okay, I think...
There's two more.
Not two more?
Yeah, two. Oh, now one more.
Okay.
One, yeah.
I think it's, let me see whether I can pick it up in my...
Tando had his hand up.
Who?
Tando 82 had his hand up.
Okay, please go ahead. Yeah.
Oh yes, my name is Tando Shambira.
Oh, Tando, yeah.
I'm in the UK. I'm Dr. Richard's student, originally from Zimbabwe. And thank you for letting me join in. I'll draw my question, or rather comment, to Catherine on the infrastructure, or rather the resources being overwhelmed by the debt. However, on that, I'll try to comment on how maybe Africa is shooting itself by negotiating for infrastructure development, which is mainly extraction of resources and leveraging on that, without consolidating and negotiating for infrastructure extraction and infrastructure for processing, which will then add value. Because if we look hypothetically in countries, I'll give an example of Zimbabwe, the diamond infrastructure invested by the Chinese. There's a company called Engine. What it is, they take away the raw diamonds for cutting in China, whereas if Zimbabwe had negotiated for the infrastructure, finance the infrastructure for extraction and processing on site, then the diamonds would leave Zimbabwe with an added value where that debt will not be like a debt trap. And then secondly, I think Robert did comment on the World Bank issue, the delay in issuing the loans. Well, Africa is caught up in infrastructural development, finance deficiency, and then there's also the political side, the democratization of processes post-colonial era, where China will process quickly and the African countries will receive. And for political expedience, because they are under pressure to satisfy domestic political interests, and therefore they'll grab on that and have an oversight of not negotiating for the secondary infrastructural development. Thank you so much.
Thank you, Sando. Very, very helpful commentary and, right on the dot. I don't know whether Hongbo, this was a comment where they want to add to this. So,
so I think the second point on the political, there are intra-political problem or issues that we cannot really consider here. But we do see the pattern that when they change the president, when they change the government officials, they renegotiate. So they do the negotiation with China because they do not trust what the previous government negotiated with China. So that's one thing. But I think you got that a very good point in terms of the local value added, and which I think is a very economically meaningful point, because you are basically arguing that why do I just export commodities directly to China? Instead, so why don't host government allow their own firm to process, to do something, and then to use their own labor, and therefore that value will be contributing to their own GDP. So I think that's something we should consider. So in terms of this barter treatment, can they do more? Can they think about something that we use local labor to make those resources as intermediary products, for example. So if Ghana is exporting cocoa to China for making, let's say, chocolate, can Ghana, the local people, do something and then they export maybe, I do not know what is the half product of chocolate, but can they do something like that? So therefore, you actually contribute something to the local economy by value added. I understand your point, but it's a question of how we should consider this empirically and in terms of the data availability, etc., etc. But I do like that concept. Thank you.
Thank you very much. I think we're about to close. Maybe Dr. Peter Rose, I can see your hand up. Let's say some parting shots.
Thank you so much, Professor Murinde. Thank you for allowing me to second time. I'm getting so excited. I'll bring my knowledge to bear because let's look at the situation of China. They are prepared to be very flexible, and if you certainly borrowed, you cannot repay. They will renegotiate. They will extend the loan, but with the World Bank and other institutions, you'll be suspended. You'll be punished. So that's the huge difference between China and other international institutions. For example, I'll also share a good experience with you. I know at the World Bank board, and I'm sure you are aware of that, Professor. Yes. So the UN has got a map of the world, Africa by night. They always talk about energy as the key driver of development. But when you look at the map, Africa is in the dark. Come on, it's a shame on these international development institutions when they say, okay, if we bring energy, there'll be more infrastructure development. We will reduce poverty. Not poverty very loosely, but we don't mean it. Thank you, Professor, for allowing me to share my views.
Thank you very much. I think at this time, I would like to thank everybody here. I want to thank our external guests who have come from all over the world to attend this seminar. I can also look, I can see Emilio Nyema in the audience. I can see Jeffrey Charles, once again, Francois. Again, I can see Ron Bolanda from SDO, Rose Ngugi, Sandrine Kablan, and many, many people. We thank you very much for being able to join us. Please join us next week. We have a truly exciting seminar and a paper which is already on the web, a long paper, almost 100 pages, which is most comprehensive work on the fintech revolution, the financial technologies revolution. What are the opportunities and risks? That will be the seminar next week. Until then, please bye-bye and have a good time, and thanks very much for being able to come.
Thank you very much.
Thank you.